Now we're going to look at another important, or you can say a small type of strategic for you project managers on how you can enhance your cash flow position of a project. Okay, what are the small steps, small improvements which you can undertake as a project manager to make sure you have a good cash flow position, or even better that you are improving your existing cash flow position. The first is increasing the credit period from the vendors. Now if you are having a bulk procurement, if you're purchasing the goods in a bulk quantity from your vendors, you can negotiate for a good deal of a credit period within them. Suppose if you have an existing credit period of 60 days, you can get it extended to somewhere around 90 days at least. Okay, but it depends on the quantities which you're going to purchase from them. Or if you have a good relation with them where you have been paying your credit on timely basis to them within the due dates, make sure to utilize the entire credit period from them. You might be wondering, how is that enhancing, or you can say how is utilizing the credit period going to enhance my project value, my cash flow position? It does nowadays. At least there are funds where you can park the additional funds above, just say any funds above 5,000 can be parked in an FD for at least 7 days. Okay, the minimum requirement is 7 days and 5,000 rupees. So let's say you have to pay a vendor an amount of rupees 1 or 2 lakh, and you have been paying it before the credit period gets over, supposedly within 30 days. You're losing the opportunity to earn entire 1 month of interest, and your vendor who's receiving funds from you early is going to park the funds in his own account FDs and get an interest from that funds. So try to get more credit period from the vendors is the first principle. If not more, negotiate for a cash discounts, for a rate discount, a good discount rates, and at least make sure to utilize the entire credit period from your vendors rather than paying it upfront to them just for the sake of maintaining a good relation. No, if you have a 60 days credit period, it's better to pay on the 59th day and utilize and keep those funds parked in an liquid investment, or you can say kind of fixed deposit for those 59 days and earn an interest income for your project, for your, which will improve your cash flow position. Next is decreasing the credit period of the debtors. Now here you need to do exactly the opposite of which you are doing for your creditors. Negotiate with the debtors, show them the benefits which your project is giving them, show them the benefit which the goods are going to give to them, and try to negotiate it and negotiate the credit period down to, supposedly if you have an existing credit period of 90 days, try to get it down to 60 days or even better 30 days. That's how you negotiate and get more. The earlier you receive the funds with you, the more you can park them in a liquid investments and earn a passive income from that also. Okay, the idea here is to get the money in your control as soon as possible so you can invest it for your own betterment. Okay, those are the strategies which you need to apply as a cash project manager. Other thing is eliminating the unnecessary expenditures. Obviously, if we take a deep look, if we scrutinize our records, every cash, every penny spent, we realize most of the time, not in just project manager, but also in a personal life, there are a lot of opportunities where we can save the money, where we can save the unnecessary expenditures. And not only that, saving of the unnecessary expenditures, but when we invest those unnecessary expenditures very well, smartly, we earn a good amount of income on that, a passive income. In the personal life, that leads us to a financial independence, financial intelligence. In the project management perspective, it leads you to a better cash flow, a positive cash flow, an enhanced version of your positive cash flow. Next is investing the idle cash to generate a passive income. As the guy said in the book The Richest Man in Babylon, never let your money sit idle. It should always be working for you 24 by 7. Whatever income you get from your cash flow, you keep on investing that, investing that, investing that. And that compounding of interest gives you multiple fold returns. But that's applicable for a long-term scenario, 10, 15 years down the line as a project manager. But still, it's important that whatever cash savings you are making, any unnecessary expenditures eliminated, any received from the debtors earned at an earlier point of time, any payments made to creditor by and using the entire credit period, you need to generate a cash income on that. And how can that be done? By investing it in a surplus, by investing those surplus cash, right? Lastly, make sure to repay the loans and the interest on the due dates to avoid the penalties and additional interest payments on the late payments. This is applicable when you have taken a loan or for your project. Okay, when you have been given a loan for your project and management of that loan is entirely up to you. So in that case, make sure you're paying up the loan, especially on the proper due dates, making the entire interest payments on the due dates, and thereby maintaining not only a good credit position but you're also avoiding a lot of bad reputation, a lot of additional interest payments and penalties, a lot of cash outflow which could have been gone out by way of additional interest payments and penalties and so on. So these were some of the few pointers which you can use as a project manager to enhance the cash flow position of your project, to generate a positive cash flow position on your project. I hope with this you are able to comfortably analyze a cash flow position, study the cash flow position, prepare one for your own, and apply the steps to enhance and come up with more tips on your depending on your projects to enhance your cash flow position for the project. With this, we complete a part B of cash flow. In the next session, we're going to start with the ROI, that is return on investment.